Good evening, ladies and gentlemen. We are in the final stage of Finance Conclave 2022, and the topic for the session is risk assessment of debt investments. Debt investments occupies an important position in our portfolio, either due to our approach to investments or the asset allocation that we follow. We have Mrs.Revati Kasture, Senior Director at Care Ratings, to take us through the risk assessment we need to understand before we invest in variety of debt investment options. Mrs. Revati Kasture is a Senior Director at Care Ratings and has a work experience of 24 years with specialization in the areas of credit risk assessment, research and strategy. She is currently heading the criteria and quality control team at Care Ratings, responsible for strengthening methodologies and enhancing the objectivity in ratings. Her role also entails interacting with regulators and contributing to policy formation. She has been a keen in imparting knowledge and has been part of the training faculty of care trainings in India and abroad. She has co-authored the course book for India's first certification course in credit analysis, Certified Credit Research Analyst program. She has given views on topical subjects on leading news channels such as BBC World, CNBC, NDTV. She has authored and co-authored many articles and have been published in business industry journals as well as financial dailies. She is a merit rank holder, chartered accountant and a cost accountant, and has been honored with Professional Achievers Women 2011 Award by Institute of Chartered Accountants. She is a member of Advisory Board of Symbiosis Institute of Banking and Finance, Pune, and also a member of Advisory Committee of Birla Institute of Management and Technology, Greater Noida. With that introduction, let us welcome Mrs. Revati Kasture, our today's guest speaker, to share her views on the topic. But before I hand over the mic to her, I will be giving her a memento. So stage is all yours. Yes.
Hello. Yeah. Thank you so much, Dhruv, for actually reading out the whole of the profile. So thank you so much for that, and thank you, Dhruv sir, for inviting me yet again to address this gathering. I'm so happy to see so many young faces over here, apart from very. No, you don't have to laugh, sir. I mean, we value all the wisdom you carry. So all the old investors in the markets, so we value your wisdom. But it's very heartening to see young people also taking interest in investments at such a young age. So that's really, thank you so much for all of you all for coming here. I think you had amazing sessions since morning today. A lot of different topics that were discussed, right from probably regulations to equity markets to bad bank to cryptocurrency, the latest one. And I'm sure you will have a splendid evening too, but that's not because of my presentation, that's because of the Khadya Jatra which is there downstairs. So, equity markets is a very glamorous area. All of you all will agree? Yes? You love to talk about equity markets, and everybody loves to invest in the equity markets, and India is going to be a 5 trillion economy. The markets are going to go nifty, touching a lakh points or whatever. So all that is amazing, and definitely the investor focus, so to say, has shifted a lot to the equity markets. There are significant amount of demat accounts which have been opened in the last year and a half in the pandemic, which is to say there's a lot of interest that the retail investors are taking in the equity markets, and therefore there's a lot of commentary available on that. Internationally, debt markets are much larger than equity markets. Unfortunately, in India, debt markets are much smaller as compared to the equity markets. And I come from the debt side of the business, you know. Most of the youngsters over here, if I ask them, what do they want to do? They will either say, you know, I want to work in an investment banking, right? Yes or no? No? Yes, yeah. Who wants to work in the debt markets? Let me ask you that. Anybody? Anybody? No? No? See, that's the interest in the debt markets. But let me tell you, internationally it is larger. It is much, much larger than the equity markets, and we'll go through some of the slides that I have for you. Since this is a retail focused group which is there, so I'll kind of cover some macro slides, but I'll also take you some of the investment options which are there and how do you look at debt investments from a risk perspective. So what are the areas of risk that you should be covering when you look at debt investments? So we're looking at investments in the financial markets. There are largely two avenues of investments in the financial markets. Do you agree? And I'm not talking about cryptocurrencies here. That's probably a third avenue. But largely there are two avenues. One is you invest in equities. Another is you invest in debt. Right? So the risk in the context of financial investments, is it same or similar or is it different? What do you think? For an equity investment and for a debt investment, is it same? No? What's the difference? Correct. So the risk is lower. Okay. But fundamentally, if you look at any investment, in equities you do both fundamental as well as technical analysis when you buy into a stock. In debt, you generally do more of fundamental analysis. You don't really look at the markets. And why you should or you should not, we'll talk about it a little later, but you typically don't look at technical analysis. So fundamentally, if you have to look at a company, then the equity investor sees a glass half full and a debt investor sees a glass half empty. If there's only half the glass which is available on the desk, right? That's how it is. So if there's an equity investment which is to, equity investor who's looking at a company and there are expansion plans of the company, what would you think? That it's amazing, this company is going to do very good, it's going to produce more goods, it's going to sell more goods, the stock is going to go up and so on and so forth. A debt investor would think, oh, it's going to get into capex, it's going to take a loan, it's going to have a stretch on its financials, you know, all of that. So the way of looking at it is a bit different from an equity and a debt perspective, but typically we are assessing fundamentals of a company. So what is risk in context of financial investments? There's a risk that you lose your money. Yes? Yeah, you lose your money, the full money or part of the money. And the second risk is there's an opportunity cost, which means I invested in one, but something else went up. That's the opportunity cost, right? So how do you kind of sieve through this risk? So we go through what is a debt investment, what are the types of debt investments, and what are the different risks which are associated with a debt investment. As the gentleman here said that, you know, typically debt investment is a little less risky because I'm getting my interest, isn't it? End of the day, the interest is committed to me, I'm getting my interest, probably end of the term, I get my money back. Simple, no complications. But there's a little more to that. So what are the different risks which are associated with debt investments? That's what we'll see. So what is debt? Debt is a financial investment which guarantees, which kind of tells you that there is going to be an interest component which is going to be paid you at periodic intervals, and there's going to be a principal component, repayment, which is going to come at the end of the tenure. Simply put, that is debt, right? I think this is just jumping. Yeah, so what are the different types of debt instruments? Simple ones, bank fixed deposits, everybody invests, yeah? Yes or no? Yes, okay. So bank fixed deposit, bank bonds. Are you aware there are bonds of banks? Zero coupon bonds issued by many banks. Are you aware? Do you invest? No, okay. So there are bank bonds. There are different types of bank bonds. Do you know that? There is a bank bond, which is, let's say, a zero coupon bond, which is a upper tier 2 bond of a bank. Then there is a additional tier 1 bond or a perpetual bond. Are you aware of that? There's a perpetual bond. What is a perpetual bond or what is an additional tier 1 bond? Additional tier 1 bond is a hybrid instrument, and most often than not, investors do not understand the difference between one bank bond and another bank bond. They think all are the same. They are not the same. When you look at a zero coupon bond or infrastructure bond of a bank, they are senior bonds, which means to say they are more in the nature of debt than in the nature of equity. Okay? But when you look at additional tier 1 bonds, while they are part of the equity capital of the bank, they are actually having little shades of debt and more shades of equity. Because, do you know what happened to Yes Bank? Anybody? Do you know what happened to Yes Bank? Yes? So did the fixed deposit holders lose money? Yeah. And did the 81 bond holders lose? No, fixed deposit bond holders did not lose money. Not at all. Yeah. But did the 81 bond holders lose money? Yes? They lost all money. And the reason, was it not a bond? It was a debt instrument. It was a bank liability, isn't it? But why was it not paid? Because it had shades of a hybrid debt embedded in it, which means the Reserve Bank of India says that if you make a loss, then you don't have to pay interest on a 81 bond. Right? If you consistently have negative net worth, then the 81 bond can be subsumed, can't be paid. So all those kind of different features are there in different kinds of bonds. If you do not look at those features, then you would just say, I have invested in a Yes Bank infra bond, I have invested in an 81 bond, and it's all the same. It's not all the same. Okay. It's going all over the place, that's fine. No problem. Apart from banks, there are different institutions which kind of issue bonds, and I'm talking about bonds which are subscribed and listed. There are some state utilities which issue bonds, like for example MSRDC or APRDC. Those are the kind of institutions, so state government entities. Those people issue bonds. Then there's another kind of debt investment which you make, which is mutual funds. You invest in fixed income plans, income funds, you invest in short duration funds, you invest in fixed maturity plans, and the color of all these are different. Okay? Do you lose money in fixed income plans? Has anybody lost money in fixed income plans? No? Sure? You can lose money in a fixed income plan also, and I'll tell you how. There are essentially three kinds of risk that we are talking about when we are looking at a bond investment. And I'm sorry for the presentation, I think it's just going all over the place. But there are three kinds of risk that we are really looking at when we are looking at a bond investment. One is the market risk, which he just had on the screen. It's gone? Yeah. So one is the market risk. What is a market risk? Anybody, what is a market risk in case of a debt instrument? In an equity market, what is a market risk? Sorry, I can't hear you. What is a market risk in an equity instrument? There's volatility, right? What can be volatile in a debt market? Interest rates, right? So is not an interest rate a market risk for a debt instrument? Yes, it is. And I'll tell you how. Suppose a person has invested 100 rupees in a bond, okay? And the interest rate is, let's say, 10%. Okay? So he's going to get 10 rupees every year, and it's a 5-year paper. Okay? So he's going to get 10 rupees every year. Suppose the interest rates here go down. Let's say they go to 8 rupees. The person who invested in this 10% bond is going to get 10%? Yes or no? Yes, right. A new person who is going to now invest in a bond will get only 8%. Yes? So if the person who holds a 10% bonds wants to sell his bond, would he sell it at 100 rupees or would he say I need more than 100 rupees? He'd say I need more than 100 rupees. And why would he say more than 100 rupees? Because his bond is giving you 10% interest. So his bond to any new investor will give 10% interest. So he will say that if the interest rates go down, can I say the bond value goes up? Yeah, because I'm going to get more for my bond because my bond now has a higher interest rate than what is there in the market. Conversely, if the interest rates go up, where should the bond value go? Down? Yes or no? Yeah. So if the interest rates are going up, the bond value is going down. Today what is happening to interest rates? Are they going up? Are they going down? They're going up. So what will happen to bond values? They'll go down? Okay. How is the NAV of a mutual fund calculated? It is calculated on the bond values as on a particular date of the holdings that it has. So if the mutual fund has different companies' bonds which it holds, or government bonds which it holds, or gilts which it holds, anything that it holds, it will be marked to market. If the interest rate is going up, the value of the bond will go down. So in a mutual fund, if you had invested when the interest rates were low and they are now going up, the mutual fund will lose its value. So are you now making a loss on your mutual fund, your income mutual fund or any mutual fund, which is a bond mutual fund? Are you with me on this? Yeah? So in case where interest rates is going to go up, should you get into a bond fund? Should you invest in a bond fund when the interest rates are expected to go up? No, so I'm asking you, today you are saying interest rates are going up, right? So today should I go and invest in an income fund? Yes or no? Yes. Why yes? The rate is expected to go up, right? If the rate is expected to go up, my value of my bond is going to go down. If the value of my bond is going to go down, the NAV of the mutual fund is going to go down. Then what I invested in, you are going to sell at NAV, no? You are not going to sell at individual bond, right? So if the value of the NAV is going to go down, should I invest in a debt mutual fund in an environment of high interest rates? The answer is no. So if my interest rates are expected to go down, then should I invest in debt mutual funds? Yes. And this is only when I'm talking about the trading books, okay? I'm really not talking about bonds which you invest or debt papers which you invest, which you want to hold to maturity. Hold to maturity, no problem. You have your investment, you take it, you keep it in your locker or in your demat account now, and it keeps on giving you 10 rupees every year and you're happy with it. At the end of 5 years, you get 100 rupees, great, amazing. No market risk, right? But if you want to trade in debt securities or if you want to buy and sell mutual funds, most of the mutual funds are open-ended, which means you can get in and get out at any point in time, right? So if you want to do that, then you need to be aware of the market risk which is embedded in any debt investment, right? That's the first kind of risk which is embedded in any debt investment. The second kind of risk is credit risk, and that's pretty close to my heart because that's what I've been doing all years long, right? What is credit risk for you? What does it mean? I invested in a company at 100 rupees at 10% interest rate, and I don't want to sell the bond. I don't have a market risk, right? Except the opportunity risk that tomorrow that company may issue a 12% bond and it's possible. But by and large on this one, I don't have. But do I have a credit risk? So what is understood by credit risk? Credit risk is the risk of that company not paying back my money, whether interest or principal, on time. And here we are not talking about recovery and security and all that. We're not talking about that, okay? I'm just plainly simple cash flow. Because at the end of the day, cash is king, no? After you sell the security, you get some money and all, that's fine, yeah? But here we're talking about simple cash flow. So it's not going ahead at all? Because I have some pictures. Okay, so here we're talking about simple cash flow. So there's the ability, willingness of a company to pay back your money is what we call credit risk. And every debt instrument has a credit risk. Does a bank FD have a credit risk? Yes? Yes. After 5 lakhs, the government is also not going to pay you, right? So even a bank FD has a credit risk. If the bank goes bad, a lot of cooperative banks have gone bad in the past. Private sector banks, Yes Bank being a case in point, has gone bad. So there is a credit risk even in a bank fixed deposit, depending on which bank you choose. Similarly, there is a credit risk in every kind of debt instrument, whether it's a mutual fund, whether it is a company bond, company FD, any kind of instrument which does not have the government's blessings, because government can print money. So there's generally no credit risk in gilts, and there's no credit risk in government insurance companies selling plans which are assured bonus or whatever plans, right? There's no credit risk there. Oh, I forgot about yields. Okay, so in case of credit risk, how do we assess credit risk? But before we go to that, I just wanted to kind of go back to this market risk. I forgot to explain interest rates and yields. Interest rate is the rate which is coupon, which is guaranteed to you. It says that this instrument has 10%, whatever. What is a yield? Yield is the rate of income that you earn on your investment because you got into that investment. So for example, if 100 rupees bond carries an interest rate of 6%, then, and if the bond is trading at 100 rupees, then the yield is 6%. But if a 100 rupees bond which carries an interest rate of 6% is trading at 80 rupees, then for 80 rupees I am going to get 6 rupees. So I am getting a return of 7.5%, so that is my yield. So this is the income yield that we are talking about, and there's another concept known as yield to maturity. Anybody knows yield to maturity? Anybody? No? So yield to maturity is essentially not only the interest component but also the maturity value. So at the end of the term, whatever money I am going to get. So in this particular example, if you buy the bond at 80 rupees, your income yield is 7.5%. But at the end of 5 years, you are going to get 100 rupees back, which means that 80 rupees plus 20 rupees of capital gains also you are going to get. And that will get added to your yield, so your yield to maturity will be much, much higher. In case you are looking at the debt markets from in NSE or, NSE has a bond platform, right? So whatever yields are mentioned over there, those are yield to maturities. They are not your income yields, right? So that is the yield that you really need to look at when you want to invest. And if there is a put and call option, does anybody here follow put and call option? Yeah, so what is a put option? Sorry? Right, but not the no, in the context of equity, nahi, in the context of bond. Right, but not an obligation. A put option is when the issuer has a right to buy back the bond. And a call option, it's when the investor has a right to tell the issuer to give the money back. And a call option is when an issuer calls the bond back. Okay, so whenever there is a put and call option in a bond, then you need to look at yield to period and not yield to maturity. So whenever that put or call is getting triggered, that's the price that you are really interested in yield, because that's when the money will come back to you, right? So in a put and call option, you look at yield to price and not yield to maturity. Go next. I hope I'll go in the same order. Okay, so we're talking about credit risk. How is credit risk measured? Credit risk is measured in terms of the ratings which are given out in the public domain. So if you are aware, Indian rating agencies give ratings from AAA to D. AAA and AA being the highest rated, and single A and triple B being moderately rated, and anything below triple B is a sub-investment grade rating or a rating that you should not invest in. But in the Indian bond markets, we typically have only AAA and AA rated papers available in the market, unlike in the US where junk bonds are also traded. A lot of trading happens in junk bonds, which means sub-investment grade bonds in developed markets, and there is a market available for those. This is just the rating scale. So if you look at this scale, whatever is available in the Indian markets is only AAA and AA. There is hardly any A-rated paper also. So credit risk typically is not very, very potent in the Indian markets because you are not getting paper which is low credit risk. You are getting papers which are high credit risk in any case. And low credit risk papers, there is no investor. None of, very few of you would be investing in bonds, right? Do you invest in bonds, any of you all? No. So that's how it is, because the retail investors don't invest in bonds. And even if it is AAA and AA, they don't invest in bonds, because they don't know. Do you know from your stockbroker equity account, you can also invest in bonds? You know that? But you don't go and invest, right? So that's why there is very less retail participation in the debt markets, and that is why there is less awareness, and therefore only the high rated papers are available, that also at a very small liquidity which is there. So the credit risk per se in the Indian markets is not as pronounced, but if we do get to invest in papers which are rated lower, then that's when the credit risk will really play out. Now, what is one of the risks which plays out in the Indian markets is the liquidity risk. So if you look at India, the Indian bond market as a percentage of GDP is only 16%. The US bond market as a percentage of their GDP is more than 100%. You can skip this, it's fine. It's more than 100% in the US, and in most developed markets it's very high numbers as a percentage of GDP. But the Indian markets, and about 70% of the bond markets in India is gilt, which is government securities. 30% is only the corporate bond market. So that's how low it is. It's a very, very small proportion. Go ahead. Yeah. So it's a very, very small proportion. So what is liquidity risk per se? Liquidity risk is when I want my money back, do I get my money back? Right? That is simply put liquidity risk. That means when I want to sell an equity share, can I go in the market and sell it? The answer is yes for most of the traded scrips. But in case of debt securities, it is not really so. So about 65 to about 16 to 17% of the debt securities which are listed are actually traded. So that is the small proportion of traded. So if you look at outstanding corporate bonds as a percentage of GDP, I said India is 16%, US is somewhere around 105%, Hong Kong is 27%, China is 29%. So we still have a long way to go there. Go to the next slide. Yeah. Yeah, so as I was saying, the liquidity in the markets, in Indian markets is pretty low. Even if you look at the trading and corporate debt as against equity, and this chart has that, the bigger blue line is what is the trading volume in equity in lakh crores, and it's about some 16 lakh crores, whereas in bonds it's only 1.3 lakh crores in a month. These are all monthly numbers that are there. So it's extremely, extremely small, and therefore it's possible that if you invest in bonds, you may really not be able to get out. Now what does the regulator do for this? The regulator has something which they call market makers. Go to the next. They have something which is called the market makers. Now, who are market makers? Market makers are people who give buy and sell quotes so that the liquidity in the market is maintained. In equity markets, you really don't need market makers, but in the debt market, you need market makers. So for government securities, the primary dealers, you've heard of primary dealers? These are entities which buy and sell government securities. These are the people who give buy and sell quotes, and they are the market makers for the government or the gilt market. However, for the corporate bond market, SEBI had in November 2021 come out with a consultation paper for creating market makers for the bond market. but it has gone nowhere because the suggestions were that the issuer should keep 25% of the issue as earmarked for market making. Nobody is going to take a negative carry on his issue if at all such market making is to be done. Am I going too much above board? You guys are with me, right? Yeah, okay. So, I have mentioned this, G6 is 70%. So as I was saying, the equity, so no issuer really wants to do 25% as a negative carry or fund 25% of the bonds that he's raised and allow market making to happen. Another problem with market making is that the buy and sell quotes will really not be good for the investors because they will not be accretive or the best quotes or the market determined quotes. There is nothing like a market determined quote. These will be given by these issuers and therefore they might be biased, they might be detrimental to the investor. So that's also one of the reasons why I guess SEBI didn't go ahead with this market making consultation paper which they had come up with. So having said that, typically as I said, 3 types of risk, and really sorry for this presentation, but 3 types of risk which are there. Liquidity risk is, as far as I see it, a very real risk in the Indian markets. The institutional investors also hold to maturity, they do not trade. It's only the mutual funds who are trading in the debt market, and demand is confined to institutional investors. Retail investors today form only 3% of the debt market. That's low how we are, only 3%. Private placement is a dominant form of placement, so there are less public issues, so really you can't go and invest. But can you invest in G6? Do you know whether you can invest in G6? Yes? Yes, you can invest in G6 because RBI has allowed that facility to invest in G6 through a direct account which you can open with RBI. However, there's not too much participation of retail investors in that also. There are different kind of structures. Have you heard about market-linked debentures? Have you heard about market-linked debentures? Yes, no? Sorry, I can't hear you. Those are bonds, those are again government bonds, inflation-linked credit bonds, yeah. But market-linked debentures are different. Market-linked debentures are instruments where a company which issues the debenture says that if the equity markets go above this, then I will pay you so much interest. If the equity markets goes below this level, I will pay you this interest. And if the equity markets is between these 2 levels, I will pay you this interest. That is what is a market-linked debenture. And most of the market-linked debentures in India which are issued are principal protected market-linked debentures. A lot of NBFCs issue these market-linked debentures. Most often than not, these conditions are hugely technical as of now because the upper threshold of market going beyond and the lower threshold of market going beyond is generally never met. So they are always in the middle. So none of the market-linked debentures, even though they have these thresholds, because they'll say, if the market tanks 75%, do you really think it happens? It doesn't happen, right? So if the market tanks 75%, I will pay you so much. If the market goes 50% above today's in the next 1 year, I will pay you so much. Market is not going to go 50% above today's level in the next 1 year. So that's how it is. So these are the different options which are there. Into different kind of securities. Most of these can be invested by a retail investor. Some of these, like market-linked debentures extra, are typically offered to high net worth individuals because they have a threshold of 10 lakhs and above in many cases. Having said that, there are some which are offered at a 1 lakh threshold also. So these are different debt investment opportunities. What you should do is evaluate all these options, see what is best for you in the time horizon, and remember all these different kinds of risk which are there before you invest in a debt paper. Can we go next one? I think it should be, thank you. So this presentation really didn't work, but I hope my talk did. As I said, non-convertible debentures, bonds, they remain the same thing. Are they safe? Depends upon what is the credit rating when you are talking about safety, because safety is addressed by credit risk. Safety is not addressed by liquidity or market risk, it's addressed by credit risk. So when you say they are safe or not, depends on what is the rating of that particular debenture or that instrument that you are getting into, you should look at it. If you are looking at a hold to maturity kind of scenario. Yeah. NCDs are debt investments. Correct.
What is the
Safety of that?
Yeah.
Okay. So I'll tell you. Yeah, you're right. So, the cumulative default rate, okay, for a AAA in India is 0.5%, which means, is it possible for a AAA to default? The answer is yes. What is the probability? 0.5. That's how it is. So in cases where there are frauds, for example, Diwan Housing, for example, Yes Bank, for example, Reliance Capital, right? So in places where there are frauds, it's very difficult for anybody to unearth that unless you do a forensic. And forensic is not done by any of the agencies or any rating agency doesn't do any, it is trust and verify. It is not doubt and investigate. So when you do that, it's not possible that, you kind of, there is no guarantee that a AAA will always pay. But, there is a 0.5 probability that it defaults. Now, whether it comes on this particular instrument or it comes on some other paper, we don't know. But that is the statistics. So having said that, yes, in case of Diwan Housing, yes, there was a problem, but the problem was related to fraudulent accounts which were maintained by the company and shown to people and shown to rating agencies. So if that's the kind of fraudulent account which is there is very little possibility that an agency will be able to spot that. Yes, that's correct. I agree. Retail investor goes by the rating, and I'm not here for a moment saying that you should absorb everybody involved in the process. But what I'm saying is that every person, so the company is responsible, the auditor is responsible, the rating agency is responsible. Everybody in the chain is responsible for a mishap which happens. But 99.5% of AAAs have paid on time. That's the point I'm trying to make.
which is the other rating agency other than the care?
Oh, there are lots. There are 7 in India, which is a big problem actually.
Which is the best?
Best. So there are top 3 rating agencies in India. So worldwide, in all markets, whenever you talk about rating agencies, you generally have top 3 agencies that you look up to. Internationally, it's always S&P's, Moody's, and Fitch. In whatever markets that you see, these are either number 1, 2, 3, depending upon who has what market share. In India, it is CRISIL with number 1 market share. I'm talking about market share. CARE is second and ICRA is third.
Recently, this information by RBI on deep discount bond. What is it?
What? I didn't get the question. Discount box.
This information by RBI because some banks, some key public sector banks issue deep discount bond.
Right.
Issue a discount.
And then redeem at the pump. That's
For
correct.
5 years or 10 years.
Right.
Do you have more information on who is issuing?
I don't think there are many banks which are issuing these discount box today. I don't think that product is very well known in the market.
Previously it was there.
Previously it was there. Previously all banks issue deep discount. It's just a way of calculation. You put 100 rupees today and you're getting 150 at the end of 5 years, or you put 75 rupees today and you're getting 100 at the end of 5 years. How is it different? It's just the rate which is different.
They have also not given the money, right?
They have not given the money.
Yeah.
They don't know of such banks. Who have not given the money.
was there.
Canada Bank.
Yeah, 15 years back.
15 years back.
Yeah.
I don't know. Last question. Any last question? There is no correlation which can be established between debt markets and equity markets because the parameters on which they run are different. So an equity market typically, so if you can ask me what are the parameters which are there and how do they affect the debt market and the equity market, I'll probably be able to answer this better. So if you have a rising interest rate scenario, then the debt market, the value of the bonds go down. The equity market also, there is a possibility that the value of the security goes down because the interest that the company has to pay has increased and the profit will go down and therefore the value of the security will go down. So if that's how you would really look at it. Which market is going up? So that depends on your risk perception, honestly. I mean, how do you think you should be allocating your capital? And debt and equity are not the only two things. There are other assets also like real estate, gold, which are there. So you're saying aggressive plan, balanced plan, conservative plan, that way. That again depends on your risk perception. If you're an investor who thinks that, the equity markets are going to give you higher returns and therefore you should invest in equity, I think you should choose the aggressive option. Yeah, that kind of a dynamics which is always desirable, though I don't think many investors do that. So if the interest rates are going up, okay, then you should come out of debt and go to equity because debt will give you a much higher loss than the equity in the short term. Any other questions? Yeah, there.
Yeah, last one question, please. Yeah.
Yeah.
Okay, so let's not take just one example. Let's take any isolated example. So the criteria for investment in NCDs is
you should look at what is the fundamentals of the company, whether fundamentally the company is good, bad, what is the duration of the NCD, so at how long is the NCD you're going to hold, and depends on your perception of how long you want your money to be locked in, because as I said, there is a huge liquidity risk. You really can't go and sell that NCD in the market. And you should look at what are the prevailing interest rates. If at all you feel that the interest rate is going to go up in near future, then you might as well invest a little later than what you would invest today. So essentially three things: fundamentals, market, how's the interest rate movement happening, and liquidity, which you have to consider, which means when do you need the money in future. So these are more of financial planning related questions rather than debt related questions. Yes.
right. So that's not how it is. So okay, there are two different aspects. When you look at the rating, it talks about probability of default. Okay, we don't really tell you that loss, given that there is a default, this is the percentage or the recovery percentage, which is a totally different aspect. So the security per se will give you
stay invested even after liquidation. So after liquidation also you can stake your claim, that security can be sold and you can get some money back. May not be the entire money back. So there's a certain portion of loss given that the default has happened. A rating is only up to the point of the default happening. So we say whether default happens or doesn't happen. What is the probability of that happening? After that also you might get. So DHFL, I'll tell you an example of DHFL itself. DHFL had a lot of securitized papers, if you know, right? Not a single securitized paper has got a single rupee of loss given default. Do you know that? You probably don't, right? Not a single securitized paper has got a single rupee of default, given that the ratings went from AAA to D because there was some legal embargo on payment, it didn't pay on due date. However, after that, the security was so strong that every rupee was repaid for DHFL also. So not everybody has lost money there. So I don't think for any private company you have this government limit of 5 lakhs where they guarantee or something. I don't think that's the case.
Yeah, that's it.
It's done on the basis of credit risk only, not on basis of market volatility. Yeah? Thank you so much.
Thank you very much, Mrs. Revati, Kasture. You have touched upon several basic conceptual topics, especially for the young generation who is attending this session today. Concept of market risk, credit risk, liquidity, concept of yield, interest rates and YTM, and how to differentiate further how one should approach investment in a mutual fund scenario in a rising or a falling interest rates. So you've given us an insight. So we thank you for sparing your time on a Sunday evening and accepting our invitation for this session. Thank you very much.
Friends, we are coming to an end of this session, so I will take not more than 5 to 7 minutes. We are here since morning 10 o'clock. So first of all, I thank all of you for being with us throughout the day. Sunday, whole day spending is a difficult task. So we started with investors' protection, which is important. The lesson that we all need to learn from this is that there is a police station and it will take care of, the theft and burglary and other things, etc. But that doesn't mean that we should go out of the house without locking the doors or taking proper precaution. So that the same rule will apply even in so far as investment is concerned, and that is what Mr. Hariharan stated. When Mr. Bide came, he talked about various alternative investment modes, and these alternative investment modes are really important, really valuable, and yet people in general feel that this is only for HNI people, and so, but yes, it is quite possible that investment options from that area can also be considered. Bad bank, NPAs, and all those things are the topics of the day, and Mr. Murugan Paranspe was quite candid enough to explain all these nuances of this particular situation in which we were facing difficulties right from 2015 onwards. Hopefully, according to him, all these things will last only for next 10 years, and this NPA business or this fraud business would largely come to an end. That is his hope, fervent hope, and let's hope that there are no more bank failures. And then there was Professor Shelatkar, who gave us all rosy picture of the equity market, how it is going to explode, and it was not only interesting but illuminative and illustrative talk. We all enjoyed it. Thereafter we had something from virtual. We kept this topic specifically because we wanted people to be away from this crypto hype that is available at the moment in our country. But then whenever we talk of investments, people in general, whenever they meet, they talk of this cryptocurrency, and so they wanted someone to speak to them authentically that yes, there is a lot of talk, but there are no regulations, and there are plenty of difficulties which people will face. So as an investor, to the extent possible, without understanding, at the moment it is better just to skip this or to avoid this, that will be the best thing to do in the present scenario. When we came to debt market, it is really unfortunate that in our country, debt market, retail debt market for that matter, is not developed to that extent. And yet, we thought as organizers that we should have a flavor of debt, and that is always considered to be a proper allocation where there should be a mix of debt and equity. So from that angle, the rate of interest, how much do we get, how much, to what extent it is safe, and all these things were explained to us by Revati Kasture. She had earlier also given us a talk insofar as rating agencies are concerned. So it was very nice on our part. So on behalf of Lokmanya Seva Sangha Investment Guidance Cell, I profusely thank all our speakers from the morning, and I request all of you to carry this vote of thanks with a loud applause. This was the major event after the break. After the lockdown COVID period, people in general have started meeting each other. So our managing committee members, Dhruva Patil is present over here, Anil Londe is here, Uday Tardalkar, Sujit Wangankar. They made all efforts to inform all their friends that you please come, attend this session. The lectures are good, they are going to be useful, so that we make a beginning of physical meetings, understanding, etc. So I would like to thank our managing committee members. In fact, Santosh Lagu, although he came yesterday late at night, he at least joined in the afternoon. So all of them have contributed for making this program a grand success. So I should thank all of you over here. And last but not the least, I would like to thank all the participants who remained present over here. Without your presence, all this investment or talk about this informed investment decisions, etc., is really not possible unless there is a wide-scale participation from all of you. So without your presence, this would not have been a success. I should also thank specially the students who joined here from Parle Institute of Management, Dahanukar College, Vidyalankar classes. All of them had joined. I hope that they will make a summary of what they have heard, what they have learned, and make a presentation to us. And yes, you will be eligible for a prize for writing a proper summary. So I especially thank all these students who came over here. And so now let me join us. We shall end this finance fair as usual. All our programs we end with a prayer, the Pasayadan, etc. So let's all wait for Pasayadan. Yeah. It is a slip of my mind. I should thank Lokmanya Seva Sangha, our parent organization. All their office bearers also took active part. In fact, the president was present right from morning. Vice President Deepak Gaisas, Sunil Mone, Rashmita Fadnavis, all of them were present and helping us in taking up this. Yeah. And there is an announcement that membership fees of PV Bhagwat Investment Guidance Cell from April 22 to March 23. Please become members. nominal fee of 200 rupees per annum just for the sake of showing it to SEBI. Otherwise, our investment guidance is free of charge to the members who are really interested in joining. Okay. It's an investment. Yeah, it's an investment that you are making. So let's end by praying. आता विश्वात्मके देवे येणे वाग्यज्ञे तोषावे तोषोनी मज द्यावे पसाय दान हे लेखांची व्यंकटी सांडो तया सत्कर्मी रती वाढो भूता परस्परे पडो मैत्र जीवांचे दुरितांचे तिमिर जाओ विश्वस्वधर्म सूर्ये पाहो जुजे वांछील तो ते लाओ प्राणी जात वर्षत सकळ मंगळी ईश्वर निष्ठांची मांदी आई अनवरत भूमंडळी भेट तू भूता चला कल्पतरूचे आरव चेतना चिंतामणीचे गाव भूरते जे अर्णव पियुषांचे चंद्रमेचे अलांछन मार्तंड जे तापहीन ते सर्वाई सदा सज्जन सोय रे होतू किंबहुना सर्व सुखी पूर्ण होऊनी तिन्ही लोकी भजिजो आदि पुरुखी अखंडित आणि ग्रंथोपजीविये विशेषी लोकीये दृष्टादुष्ट विजये होवा ओजी येत म्हणे श्री विश्वेश्वराओ आओ येईल दान पसाओ येणे वरे ज्ञानदेव सुखिया झाला. Thanks.